Good afternoon. Hello, my friends. Mic check. How's everybody doing? Great to see you. Welcome in. Get comfy. Grab a chair. Pour a beverage. Smash the likes. Let's do it. Hello. Welcome, friends, to Alpha Beta Soup. It's your boy TXMC. It is March 8th, 2024. Friday. The Friday before spring break for a lot of youngsters. Hit the like button if you haven't already. Say hello to your friends in the chat. Good to see everyone today. Wow, what a week. What a week. It's been a bit of a journey, just the last 24 hours trying to figure out, man, what do I fit into the stream? You know, we got all this job data. We had Jerome Powell talking to Congress. We've got Bitcoin touching all-time highs 2 different times this week. You know, we've got an alt season going on. Nvidia's going up like 3% a day for like it's just every day. So, whew, lots to discuss. We'll try to fit it in a timely manner today and not keep you forever because it is a Friday. So we'll try to run this stream nice and light. And then after our public stream today, we'll take about a half-hour break, and then we will do a member stream. It is member stream day. We'll do a private stream for all the green names in the chat. And we'll hang out for a bit after the public stream today and a brief intermission. What we usually do, we've been doing it the first week of the month. Today will be the 3rd or 4th member stream. I can't remember if we started in December or January, but nonetheless, we will do one today. Very excited about that. Not as much of an agenda on the member stream. We just kind of hang out. I answer your questions. They're not always as long, but it's just kind of more of a chance for us to be a little more casual, not public facing. You know, we can maybe talk about things that don't always make it into the streams and just kind of shoot the breeze a bit. And it's less driven by me and the points that I want to make. But anyway, good to see everyone in the chat. See a lot of friendly names. I see Oscar Santana. I see Mr. Nobody. I see David McGee. I see CB, XP Market, Ursix in the chat. Mr. Q's out there. What's up, everyone? Welcome. Andy Philpott, David. So, man, it's been a busy week. I'm not breaking any news by telling you that Bitcoin touched the all-time high on Tuesday and immediately dumped. It spent less than a minute up there. And once it pushed above 69,000, we got this quick sell-off, swept the entire structure and the lows from the area building up to it in the days before, the whole like week beforehand, basically. And since then, we've been trying to recover. And just this morning, we poked higher again and another sell-off, but not nearly as large. Now, in volume terms, the actual move above the all-time high was the same kind of volume level on the hourly candle on Coinbase as it was back here. See this? So roughly the same level. The only difference is this led to like a massive cascade. And we saw, if you look on Velo, which I was looking at before this, let me see if I can pull this up. Yeah, here it is. If we look on Velo Data, this is one of the data providers that I use. Shout out to Velo; these guys are awesome. This was the flush the other day, and we can see if you look at these figures right here on this side of the screen, and if I put my mouse over this candle, you can see the highest value was 12.07 billion, and the lowest value was 9.97 billion. So that means that in this 4-hour candle, $2 billion worth of open interest was closed. Liquidation totals that you'll see on other websites might show a different number than that. It's probably a smaller number because the liquidation engines don't always report the liquidations as accurately as they can. And so a lot of them are just positions closing. So this entire move led to broadly, I mean, I guess we can count from all the way up here, about $2.5 billion of positioning closed out in like 3 hours, 2 hours. I mean, the move was much shorter than that, but we're looking at 4-hour candles here. So that was a huge drop. And then this morning we had, like I said, we had that other flush, which in volume terms was comparable on a dollar basis, but not nearly as much positioning canceled out. So this was the reset. This was just another kind of flush here at the all-time high. And maybe we keep chopping around for a bit like this. When we broke the all-time high back in 2020, we had a similar behavior. And I've seen this going around a lot on Twitter. So I'm some of you guys might have already seen this, but I'll go ahead and look. We'll show it to the audience for those who haven't. If we go back to 2020 and we look at the all-time high, this was it. And we approached it here. It was kind of a slow grind up, had this push up near the all-time high, then a dump, then a recovery, and a couple of wicks up near here. But it took, how long is this here? This is like 2 or 3 weeks, I think. Yeah, 20 days, 21 days. So this is like a 3-week period that BTC consolidated below the all-time high. And there was only really one actual pixel test of the all-time high before it broke, and that was December 1st, and it had this little wick right here. And then once it finally broke, it never came back. You can see it never came back to that level, and it was a clean snap through. So I've seen comparisons to what we're looking at today, and there are similarities, but I don't think it's exactly the same. Let me see. Why is it showing loop ring? All right, hold on one sec. Let me put BTC over here. Let me put the current BTC over here. There we go. Move down to an hourly chart. There we go. So this is kind of what we're looking at, right? And it's similar in the sense that it pushed up near the highs. We had a sell-off and now we're recovering. So like it's kind of similar, but we need more time to play out before we can say, yeah, this did the same thing as it did back in 2020. Because back here, we didn't get the same kind of, this was a much sharper dump, and it came after actually breaking the highs, whereas here it did not. And we only really got one test of it, which was right there. I mean, you can barely even see the wick right here. This is the only real test of the all-time high before the break. And once it broke, it was super clean, 1 hour, and just never came back. So here we've got multiple tests and sell-offs. It's just not exactly the same behavior, but it is the same kind of volatility. And perhaps when it's all said and done, it will produce the same kind of grinding up and then a big pop. I don't know. I was already wrong about how high Bitcoin would go in this move here. So I'm not going to waste a lot of energy trying to get cute with predicting the next leg. I don't feel compelled to. I'm still holding my spot BTC. I have a bunch of alt exposure. If it wants to keep going up, more power to the market. Let's fucking go. But as we may get into deeper into the stream here, there are, obviously copious factors that make you scratch your head as to how high and how sustainable the bull could be. But we are here. We're at the all-time highs. So we've got to be open-minded to this going on longer than we thought, taking longer than we thought, and the outcomes being different, right? From the way we could model it using past data, right? We've got to stay open, got to stay flexible. The market does whatever it wants. It doesn't care what TXMC says. And that's why part of the reason why it's always so important to me that I reinforce the idea that I'm not here giving trade signals and financial advice. I'm just trying to create a historical lens through which I can look at the current market and get an idea of what's going on, because I don't know. And so sometimes it may lead us to very prescient discoveries. Sometimes it may lead us to a dead end. Other times we might say, yeah, we're checking all of these boxes that strongly suggest XYZ outcome, and it still may not happen. It's always a probability game. And that's why I don't take trades based on macro. And that's why it's important to kind of reinforce those messages as we always look at these things. Bitcoin's doing whatever it wants. We have massive ETF flows that have exceeded expectations of even kind of the most optimistic people, save for the handful that called for $1 million in 3 months. Forget those guys, but even the most optimistic regular people have been surprised by the level of flows with BTC. And I guess it really makes sense to me because Bitcoin is highly sympathetic to tech, and tech is currently ripping exuberantly, right? We are seeing the kind of early middle stages. Some may think it's really late stages. I really don't know, but we're in a tech bubble. It's driven by AI narratives. It's very obvious that is what's happening. And so it's not that wild to think that Bitcoin and crypto broadly, it's not just BTC, are benefiting from that same kind of behavior, that same risky, speculative behavior on tech, on high beta assets. And so we've got a massive alt season. We've got meme coins doing 100x's that are named Geo Bowden and Jesus Crust, like stupid names. There's clearly a lot of bullishness, high sentiment, and a fever for speculation. If we didn't have those things, we wouldn't be seeing the market act this way. So what I think is interesting here, I'm not going to spend a whole lot of time on the timings of alt seasons and things like that. Usually BTC goes first, then Ethereum catches up, and we have an alt season that kind of marks the end of a run historically. There's a rotation through those things. We can see a little bit of that happening right now. If I show it to you here, this is the view I wanted to show. So this is Bitcoin. Well, this is the total market cap up at the top, but let me change it to BTC. So here's Bitcoin, right? Here was Tuesday. This was the break of the all-time high and the flush. And here we are today. And what I want to show you is, let me move this to the dump. Okay, so since the dump on Tuesday, here is dominance for crypto. Yellow is Bitcoin, purple is Ethereum, and red are the altcoins. Now, this is not their absolute level. This is what they have done since the dump. So they are all indexed to that dump being 100. What have they done since then? Bitcoin has come down about 2% on dominance since the dump. Altcoins have gained about 5.7% of dominance relative to the rest of the market in that period of time. We had the dump by Bitcoin here, right? And obviously crypto broadly dumped there. But since that point, first we saw a push up in Ethereum, right? There was a rotation into Ethereum and into alts as BTC was recovering. Now BTC hasn't gone down. It can lose dominance without falling because capital is rotating into other assets at a higher clip. So what we saw after the dump in BTC, it's been languishing in dominance terms, even as it has slowly climbed higher in price. It's been languishing here in dominance. We saw a rotation into Ethereum that cooled off, and it's kind of stayed there. And then a rotation into alts. The alts have been gaining market share since, Wednesday, basically. This is really like 3 days of the market right here. Very short period of time. But you can see how the capital moves throughout crypto. How we can have a dump in BTC at the all-time highs, and then as it recovers, and it doesn't just go into Hades, but as it actually recovers and kind of chops around here, and we wait to find out where it goes next, money starts moving around. It moves into ETH, and then it moves into alts. And then we wait for the next leg. And if we get another pump higher in Bitcoin, it will probably gain some more in dominance. And then when it reaches its next stopping point, we see this dynamic play out again. That's usually what happens. I think it's interesting to look at it this way. You can really see it happening. And we've seen this in past cycles. It's part of the reason why I'm still holding a bunch of alts on a swing basis for this move here, because I'm watching BTC. I expected the market not to go this high, but I have to assume that I'm also there's a likelihood of me being wrong because equities are ripping and the recession isn't here yet. And so I'm really hoping to see these dynamics continue to play out until we reach whatever top there is. Maybe it's nearby, maybe it's far away. I don't know where it is for BTC. What I have said, and I'll continue to reiterate this, is, and I tweeted this last year a few different times, was Bitcoin and crypto bottomed in 2022, and everything as far as on-chain cyclical indicators go, everything there triggered that was the bottom of the cycle. And now that we are far enough into the bear that the new cycle is ready to begin, crypto's kind of just moving forward. And it's encouraged by the rally we're seeing in tech, right? Those things go together. And what I've thought all along was that unless something interrupts the process, and clearly nothing has actually done that yet, part of our study about the economy has been trying to figure out when that would happen. It hasn't happened yet. And so in lieu of that, BTC and crypto are just going to keep moving forward in their own cyclical patterns. They're going to self-fulfill their own prophecies because it's what the market believes in, and it's going to make that happen until it is convinced not to. There would need to be some kind of a surprise event, the economy suddenly weakening, unemployment rising, some kind of a credit event, a sovereign debt problem. It could be anything. Any number of potential factors are waiting in the wings to be ignited if the right criteria unfold. Something like that would interrupt the cycle, but we haven't gotten that, and so the cycle continues. And that's kind of where we are now. It's happening very rapidly. Depending on which measures you use, the crypto rally seems to be happening sooner than before, though you can use the April 2021 top as the top of the market, and the timing looks a little more normal rather than using the November top. And so this kind of depends on how you're looking at things, and it creates a lot of mixed signals. This is a really difficult macro market to try to assess directionally, which is why I don't think this week is the right time to do that. You know, the NASDAQ is at all-time highs. The S&P is at all-time highs. The Dow Jones is at all-time highs. Bitcoin is. The DAX in Germany, the Nikkei in Japan. Yet interest rates are 5.5%. And, you know, very many pieces of the economy are suggesting that a recession's possible in this environment. The kindling is there, right? All the ingredients are in the pot. You just got to turn on the fire. And so that's what's making this cycle such a problem to analyze for folks like myself who are using history as a guide. Even if we slice and dice history into inflationary cycles, disinflationary cycles, credit-driven recessions, blah, 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 whatever, this is still kind of a unique era. It's got a little ingredients of all the different past cycles and some new things. And it's fascinating to study, but it's also kind of a bitch to predict. And it's worked out to just be the most left curve you could possibly be throughout this entire cycle, right? The left curvers have won repeatedly. And you just have to acknowledge that. People who have just said, I don't care about macro shit. I don't care about the economy. I don't care what the Fed is doing. None of that matters. Number will go up. Those people were right. And, you know, at the end of the day, you just got to tip your hat to them, because if you're in the business of making money, it's more important that you make money than you be right, or than you be right about your predictions. And so if we spend a lot of time on predictions and they don't pan out, then, you know, you can just get sent back to the drawing board over and over again. We've seen some of that happen here on the channel as we've studied this cycle. And it's okay to admit that shit. You know, I'm not married to being right about anything. That's not what it's about. I don't have a strong, like a 100% conviction in any particular outcome. All trade outcomes are random. Market outcomes can be random. What's important is that we study the data with an open mind, that we are objective, that we don't apply unnecessary narratives to information, and that when reality pushes back against us, we figure out what we missed. We look and say, okay, what did I get wrong? Which aspect of this did I not quite build into the data correctly? How can I learn for next time? It doesn't mean that all of our analysis is worthless. It doesn't mean that just because I thought BTC would run out of steam at the retracement levels and it didn't, it doesn't mean that everything we talk about is wrong or that there's no value in doing this work. There absolutely is, and sometimes you're wrong. It's just how it goes. Take a sip of water. So there's some interesting things going on in the stock market, a few points that I want to touch on. So we've got BTC at all-time highs. I showed you the crypto rotation that's going on. I showed you the similarity to the 2020 breakout and how we need to see a little more time. Gold. In this period of time, gold has been doing some worrying things. Now, I don't want to be the crotchety old gold bug guy. I'm not a gold bug. But it contains a certain kind of signal, as an outside money, as a non-government issued store of value. And it's at all-time highs. This is historically a bad omen for expansions. If you look at the gold chart and then you look at like the S&P over time, there's a lot of instances where they kind of move in opposite directions from each other. While gold is consolidating under a previous high, the market will rip. And then once gold starts to rise, the market cools off and they oscillate back and forth like this. And for equities to be pushing all-time highs and gold to be pushing all-time highs at the same time is a little worrying for me. It's just one of those things, among many other things. It goes in the red flag column, right? If you have a list of factors in your mind, and on the left are the green checks and on the right are the red flags, this one goes in the red flag column. It just has to. And when I posted this the other day, I got a little bit of pushback from some of the FinTwit folks I interact with, Bob Elliott and Lynn Alden, and they chimed in saying, well, I don't think that this is bearish, because this is them saying they don't think it's bearish because central banks have been buying a lot of gold. And that's true. Central banks have been buying a lot of gold, but that is the qualitative color that we apply to the price chart. But we don't have the ability to apply that contemporary color to every moment in the past. But the price contains much of that information because it is in the minds of the investors buying and selling gold. And so regardless of how you think it got here, the fact remains it is here. And historically, that is a bad sign for expansions. Maybe it isn't this time. If that happens, it would be unique. And maybe it just goes in the list of things that are unique this cycle. But we have to point out the historical tendency of these two assets, and they have a clear relationship, and they are typically inverse to one another most of the time. Silver also has had a strong week. Silver is less monetized than gold. It's much more, has many more industrial purposes, but it is a monetary metal. It has had a strong week as well, and that's just kind of one of those head scratcher things with equities and tech particularly sitting at all-time highs. It's just a little concerning. Like I said, the NASDAQ is at all-time highs. This is the NASDAQ 100. These are 3 moving averages, and we've looked at this view on here quite a bit together over the last few months. This is the 20-day, the 50-day, and the 200-day moving averages. And these are the number of stocks in the NASDAQ 100 that are above those levels. Now, breadth is not everything, but it tells you a story about the health of the market. Because if you are in a healthy expansion, one that is going to probably sustain itself over years and be the kind of thing that, you can just kind of set your watch on and forget and not have to fucking follow the macro every day, those kinds of expansions are typically ones that see broad participation by the market. Everything kind of goes along with it. Small caps, credit ETFs, large caps, bonds, everything kind of rises together as interest rates slowly rise into the expansion. That's usually what happens. But here we are at the all-time highs. Let me skip forward. Here we are at the all-time highs. And I showed you this last week, but I'm going to build up to something else that I want to show you today. As the NASDAQ 100 broke its all-time high, its prior high from 2021 here, since that period of time, the number of stocks over the 50-day moving average, the yellow line here, has been falling. So the NASDAQ has been climbing, but the number of stocks participating in the move has been declining. And that's really weird because literally right here is where it broke the all-time high. So it pushed up to that point, and then a bunch of stocks just stopped moving. They stopped growing. Some of them fell below their moving averages, which meant that they were sold. Because if you're pushing higher and then you suddenly go below a moving average, the moving average didn't jump over you, you fell below the moving average. Now, stocks over the 200, which is in red here, it is also slowing down a bit, which is weird considering the NASDAQ keeps pushing higher. And some of these stocks are these here that have fallen below their 50, and some of them have also fallen below their 200 day. And just on Tuesday, when we had that little flush in the market, this value touched 50, meaning only half of the NASDAQ was above its 50-day average. And the NASDAQ is up on a 50-day basis. Isn't that weird to you? That the tech index, the cap-weighted tech index, is continuing to push higher above the prior all-time high, but half of its members are below their 50-day average, their almost 2-month average. That's weird. That's not usually what you would want to see. And so I thought, well, can I look inside of the NASDAQ 100 and get any more information about the internals of that market? And I can. So I built a breadth. I built another breadth indicator. This one is the same construction as these two up here. Let me turn off the blue. This is the same thing as this, but this is only the NDXT. So we've got the NDX or the NDQ. They're the same thing. That's the NASDAQ 100. It's the 100 biggest stocks in the NASDAQ, and it's cap weighted. Whenever people talk about the NASDAQ, that's what they're talking about. The US 100 index, NDQ. That's here. Inside of the NASDAQ 100, there are sectors. Right? There are tech stocks, financials, consumer discretionary, whatever. Now it is very tech heavy, but it's not only tech. It's kind of a misnomer that gets applied to it. It is, however, 60% tech. The NASDAQ is. This here is all of the tech that's inside the NASDAQ. This is NDXT is the NASDAQ 100 tech sector. And the thing that I think is interesting here is it's seeing the same breadth weakening, but it's much stronger. So the total NASDAQ only has 60% of its members above the 50-day moving average. But inside the tech sector, it's 75%. So only 1 out of 4 are below their 2-month, call it 2-month moving average. Whereas just a couple of days ago, half of the total NASDAQ was. So 75% of 60% of the NASDAQ is above its 50-day moving average, which means that about half of it isn't. And so this is really, this itself is not indicative of future direction necessarily, but what it does is it reinforces the idea that this is a tech bubble. This is not a broadly participated in rally. And it's obvious. It's obvious in this dynamic right here. This is strange to see this. Another couple of data points, right? Let's look at the Dow. Where's the Dow? Dow 30. Pull up the Dow Jones. These are the 30 members of the Dow Jones. Go. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. No, wait, why is Apple on here? Apple's not in the Dow Jones. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. This was 12. The other day it was 13. 12 of the 30 stocks in the Dow Jones aren't even green in 2024. But the Dow Jones is up in 2024 3%, and it's at all-time highs. The Dow made an all-time high right here on February 23rd. And despite that, what did I say? 12, 13? I counted 13 the other day. I might be missing. How many do I have on here? Oh, sorry, guys. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 15, 16, 17, 18, 19, 20. 1, 2, 3, 4, 5, 6, 7, 8, 9. I am missing one. I knew it. Okay, I think that's the 13th one. 13 of 30 stocks are red for 2024, but the Dow Jones made an all-time high a week and a half ago, 2 weeks ago. The S&P is at all-time highs. Its breadth looks slightly better, but it's also a much bigger index. But the breadth inside the S&P is still at low levels, but it looks better than the NASDAQ and the Dow Jones. But I just think these are fascinating data points that we have all three major indexes at all-time highs, but there are fewer stocks above the 50-day every week since breaking the all-time high on the NASDAQ, and now it's only about 50-60% of the index. Among the tech stocks inside of it, it's 75%, which suggests tech is doing way better than everything else. However, NVIDIA is up 87% since January 1st. I don't know what it is today. That was as of yesterday. NVIDIA was up 87% for the year, but 56% of the Dow Jones is green. Only 56% of the Dow Jones is green. That's bizarre for an index that just set an all-time high. 81% on NVIDIA. I guess it pulled back a bit today. These are strange dynamics. The Russell, maybe the Russell breaks out here soon. We don't really know. It is improving, but it's below its 618 fib. It just barely crossed the 50% mark of the down leg. It is barely recovered, but everything else is far ahead of it. These are dynamics we don't usually see in expansions. These are the head scratcher things that I'm talking about. They don't mean the market has to go down, but when you look at them holistically, when you step back from a singular chart, or these ideas that we're just going to print for eternity and everything has to go up forever, these are weird dynamics, and they suggest that unless the very few stocks that are doing all the work can maintain their momentum, this is a very fragile market, right? NVIDIA is doing all the work. Broadcom is doing all the work. Dell is doing all the work. Super Microcomputer is doing all the work. There's like 7 stocks that are closely tied to AI that are doing all the heavy lifting. Meta, another one. But the number of other members of the stock market participating in this move is getting thinner and thinner. And so it's just concerning to me that it's happening on every index. So I don't know what to think about that, but I have to point it out. It's something I've got to bring up. Take some water here. So a couple other things to check in on. Jerome Powell talked to Congress yesterday. He delivered the monetary policy report, which I think he does quarterly. And I'm not going to regale you with a bunch of quotes from it because it wasn't that interesting. We follow Fed speak on here pretty well, and he didn't say anything yesterday that was new. For people who don't closely follow the Fed speak and really, really analyze it, they caught things in there they hadn't picked up on before, but he didn't actually say anything that was not uttered in prior FOMCs. So I'm not going to spend a lot of time on that. He did say his overarching message was that they are close to having enough confidence to cut rates. And currently the market is pricing in June or July for that effort. But the interesting thing is, let me pull up some of these news stories. So Jay Powell says that they're not far from having confidence to cut rates, right? But in the last few weeks, there have been 4 different Fed governors that have come out publicly and pushed back against this very idea, or at least pushed back against what their summary of projections showed in December. Do you remember when we looked at the summary of economic projections from the Fed in December, and it showed 75 basis points of cuts this year, which is essentially 3 cuts of 25 each. and the market has been expecting more than double that until very recently. Powell says we're close to having confidence to cutting. He didn't say a whole lot more about how many cuts or anything like that. Every time he's asked, he just says, look at our summary of economic projections. We'll have another one in March. He never comments. But these other Fed governors have come out and kind of thrown some cold water on the 3 cuts, which is remarkable because until just a couple of weeks ago, the market still thought we were going to have 6 or 7 cuts. And they finally came around to the idea of maybe only 3 or 4. Powell didn't do anything to dissuade that, but many of his employees are. Here we go. Michelle Bowman. She's one of the Fed governors. Not yet ready for rate cuts, willing to hike again if needed. That was on Tuesday. Raphael Bostic, another Fed governor. This was on March 4th, last week. He sees the Fed pausing after just 1 cut, and he doesn't see that cut until the 3rd quarter. Tom Barkin, another Fed governor. We need more time before I can support rate cuts. I think it's smart for us to take our time. No one wants inflation to reemerge, and given robust demand and a strong labor market, we have time. And then Neil Kashkari came out with the bomb this week. This isn't the bomb, I'll get to that. He said he sees just 2 rate cuts, maybe just 1. He said that a couple of days ago, which is kind of funny because he used to be one of the more dovish guys, and now he's trying his hardest to be one of the more hawkish ones. But what's funnier even than that was in the same set of remarks, Kashkari said, if the economy continues to be healthy, why would we cut rates? This is what I've been proposing to you guys. I've said it on Twitter a lot, is why are they going to cut in this environment the way the market thinks? That doesn't mean they won't deliver a single cut or something like that. But why would they deliver hundreds of basis points of rate cuts in this environment? Look at the stock market. We'll look at labor in a second, but it is still doing pretty well, even though you and I know it's getting weak. The headline number looks good. We are above potential on real GDP growth. We are above the historical trend of wage growth. Everybody who wants a job has a job, and the stock market's ripping. So why and credit spreads are at like historical lows. So why in God's name would they deliver 150 basis points of rate cuts this year? Unless some of those things change, right? And when we see there's little evidence here and there that maybe inflation's going to hang around a little bit longer. We got Biden proposing tax credits for home buyers. That's not going to do anything for prices, right? We got people getting 4, 5, 6% wage growth still. That's not going to help inflation. And then Neil Kashkari just comes out with this, if the economy continues to be healthy, why would we even cut? And it made me laugh because now this is just like them massaging sentiment. What Neil Kashkari said right here doesn't have to play out. Powell doesn't have to listen to him at all. He's just one guy on a board of 13 people. And so these are just his thoughts. I just find it hilarious that this whole cycle's story has been the market front-running the Fed at every opportunity. It's a cat and mouse game between speculators and Jerome Powell all the time. No one thought he would cut in the first place. They thought, if he gets to 2%, the whole economy is going to collapse. I was even kind of believing a bit of that. That didn't happen. And, he said inflation was transitory, so we can't believe anything he's said, even though he has told the truth about everything he wanted to do since the beginning of 2022. And every time there has been the possibility of economic weakness, the market jumps forward thinking a bunch of rate cuts are coming. Do you remember in 2022, in the 3rd quarter of 2022, when things started looking a little sus and everybody started thinking the Fed surely has to pivot? It's coming. It's coming by the end of the year, before Christmas. Well, here we are a whole 14, 15 months later, and that hasn't played out at all. And every turn, the market's guessing a bunch of cuts are coming, and the Fed goes, no, we're not doing that. We don't have to do that. You guys are wrong about everything. And it's really all this behavior, if you were to sum it down into a single sentence, it is the last gasps of zero interest rate policy. It's the death rattle. And the investors have been conditioned to expect a certain outcome, to expect the Fed to just pivot at any moment's notice, that they're always just going to cut rates, that their bias is to cutting. But their bias is not that now, because inflation has resurfaced, and the likelihood is, because of their mandates, that they will be more stubborn in cutting rates. And that's what we've discovered here on Alpha Beta Soup as we've studied high inflation cycles. The Fed comes in very late. And here we are in a cycle where CPI was 9% in June of 22. So you have to think in those terms. You have to shift your mindset out of the ZERP era and into one where inflation actually exists as a real threat in the minds of central bankers, right or wrong. It's the way that they operate because it's the way that they were mandated to operate. If we don't want them to raise interest rates to fight inflation, then it shouldn't be their mandate. We should give them another one. So as long as that is their job, that's what they will do. And depending on where you look, inflation ain't going away yet. So I just thought that was funny. There was one thing Powell said during his speech. There was one new thing. And he said, we should be prepared to be surprised by the next chapter in the economy. What? What? What does that mean? What does that mean? Does he know something? I don't know if he knows anything. I'm not going to tell you that this means X or Y because I don't know. I don't got a clue. But that seems a little cryptic. This is fun. Oh, I got to let my cat out of my office. Give me 1 second, guys. Oh, man. Let's touch on a few recession things and some job things, touch on job numbers, and then we'll come up for air. We'll go through the chat and we'll try to wrap this up so we can do our member stream. If you haven't hit the like button yet, please do so. Your boy's working hard. So we had all the Fed speak. They're pushing back on rate cuts. They are preparing the market for the possibility that they only cut one time in the first 6 or 7 months of the year. And today was the last day in a week in which we got a shitload of job data. So we got the Challenger job cuts. Let me open that up. Job cuts. Challenger job cuts were up in February, 9% higher than a year ago, but still relatively low compared to the labor force. These Challenger job reports are always they're a little silly because the numbers relative to how big the U.S. labor force are not very large. However, just for posterity's sake, if you look at their chart, this is the January and February totals of job cuts every year. Just the first 2 months of every year. And you can see the last 2 years have been the highest totals since the Great Financial Crisis. Now, this is still low, like I said, it's low relative to the labor force. The labor force is 160 million people, so a couple 100,000 isn't that many. But it shows you the change that's going on. This dynamic is different, right? We have elevated job cuts. The market is very tight. Labor supply is very hard to come by. And so even just a small amount of layoffs makes people really nervous because everything is pulled really tautly in the job market right now. And I just wanted to point this out, that I think this is kind of interesting, but again, it's the Challenger number. And that is, it's a little floaty. It doesn't really tether directly to the actual figures that we see. We did get some other job numbers though. So let's look at non-farm payrolls. Non-farm payrolls jumped up. Actually, let's just do it inside of here. Let's do it inside here. So non-farm payrolls came in today. It ticked higher again. This is its 6-month growth rate, 1.8%. That is the average for 2011 to 2019 on non-farm payrolls. So we are hovering at We're back to the same old levels of job growth we had between the great financial crisis and COVID. Back right there. All the strength in the labor market is gone from this perspective. However, there are two surveys of jobs, right? There's the non-farm payroll survey, there's the establishment survey, which produces the non-farm payrolls number. And then there is the household survey, which produces what Fred calls employment level. This is the household survey. And the thing that you will note about this, here is non-farm payrolls. Look at that. Up, 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 up. It has not set a low. You see that? It hasn't set a lower value since COVID. This is the household survey. It looks very different. It looks very different. On rate of change terms, it started rolling over in September. Its nominal high was in November, and this is the third month in a row that it has declined. So on a growth rate basis, the household survey is at negative 0.7% on a 6-month annualized rate, which means that on a 6-month basis, it's down about 0.3%. And so this is a very different story from over here. This is the job figure that everybody hears on the news. This is the other job figure that is from the same market. And that's why I blend them together on this channel. That's why I do that, because it produces a better number. This is what the household figure looks like. This is what it looks like going into recessions. This is what it looks like when we blend them. This is our job number we've been looking at on the channel here. This is our primary job figure, employment composite. It's a blend of non-farm and household employment. And you can see lower lows, structural lower lows on the growth rate of jobs. If we look at this compared to recessions, particularly 1966, we're going the wrong way. We're going towards the recession, towards the recessionary outcome. But there is strength elsewhere. Before I mention the strength, though, let me finish this. Let me finish pulling on this string here. Some of the other labor components we look at have begun to soften a bit. So we studied this quite a bit about there are these other pieces of labor that tend to pick up their growth rates before we see a big uptick in overall unemployment. And those things are still happening, but the results look a little mixed compared to where they were before. So job vacancy rates, those were plummeting. This is an inverted axis. So this means that they're going down. The vacancies are disappearing, but it's been softening. That rate has been softening, and now it's kind of back to break even. And that's because job openings have kind of run out of steam, right? They're not going to go down forever. At some point they level out, and they're starting to level out. You're starting to see that. They were descending, and now they're starting to level out, and they're kind of back. They're above the prior high, but like on a trending basis, they're kind of there, right? Like that's kind of where we are. So job openings have come down, and on a rate of change basis, that might not move very much anymore. And so if that's the case, then this might just stay here. It might just kind of chop around at the middle break even point. Long-term unemployment, same thing. It accelerated, but it's still kind of flat. Total unemployed persons, it's above zero, but it's kind of flat. However, job losers, people who said they were fired, and temporary workers, those are still picking up a bit in steam. So more of a mixed outlook on the leading parts of labor, but still leaning bearishly, just less bearishly than they were about 5 months ago. But there is strength elsewhere in the market that we can see. Let me go pull up that 1966 comparison again. Where was it? Here. So we know credit has like just fallen off a cliff, right? We've gone over that quite a bit here on the channel. If you're new to that, I'm just going to gloss over this. Credit growth has absolutely fallen off a cliff faster than at any point in prior cycles. It's so low as to be almost negligible in terms of rate of growth of commercial bank lending, the creation of new loans. However, because labor is tight and because wage growth and income growth is so high, That is the strength of the market. Credit has halted because the Fed has raised interest rates, and raising rates does do something. There's a lot of ideas out there that rates don't do anything to the economy anymore. They absolutely do. But we're not seeing those effects because they raised rates right after the pandemic, right after we dumped a bunch of money on people and all of the borrowers termed out their debts. So we're not seeing the effects of interest rates on actual borrowers yet en masse. We're starting to see delinquencies rise, right? We're seeing bankruptcies rise, defaults rise. However, we're not just seeing a blowout credit event. And part of that is because we are still slowly working through all of the debt that was termed out during zero interest rate policy. So we haven't digested higher interest rates yet. However, because incomes are so strong, because people are still getting a lot of money on a monthly basis, they are supporting demand. We can see that in the data. So if we look at real income growth, it's deviating from the recessionary path, and it looks more like the reacceleration from 1966, doesn't it? That's real income growth. If we look at real consumption, which is literally demand, it's you spending money. Now, this is a choppy series, and it doesn't always go negative during a recession, because even when you lose your job, you still have to spend money, right? You still have to buy groceries, you still have to pay your bills. And while some people pay less of those things and the value overall comes down, consumption doesn't always go negative in a recession, but it can slow. And it did slow, but it's holding steady. It really is. It's chopping around. It's slightly setting higher lows, which is it resembles more strongly this 1966 purple line than it does the recessionary path. But it's less clear because PCE doesn't fall that much in a recession. But those are two of the key things, really. And then if we look at wage growth. This one looks a little choppy. This one's less conclusive, so maybe we won't pull a whole lot from that one. But the real income one, I think, is one of the ones telling the better part of the story here. We know unemployment is low. We know that wage growth on a rate of change basis is quite high. Like, let me show you average hourly earnings. Let's do continuously compounded annual rate of change. Let's do bars. Let's do 5 years. Let's chop off COVID. There we are. This is an annual rate of change of average hourly earnings. Now remember, it's just your hourly rate. It's not your hours that you worked. So you have to multiply it by your hours worked. But the rate of change of people's hourly pay is solidly 3.45%. It was higher in 21. You can see it's come down a bit. However, let me draw a box on there just so we can see it a little better. Look at the consistency. This is a 5% line right here. This line right here is 5%. So we're chopping around at 5% wage growth. We have 5.5% cash rates. You can literally just get 5% from having your money in the bank while you're getting 5% wage growth, while everyone has a job. And we know that inflation is a problem. I know that cost of living is a problem. There are many factors to be worried about. We spend copious time on that. But there is also strength in the economy, and it comes from incomes. And so what that means is, because credit isn't moving and because income is the driver, any interruption to incomes, thus interruptions to labor itself, those become major problems for the economy because there is no other growth, right? If you take away the income, all that's left is the government deficit. And if we have a recession, the deficit, which is already higher than it has ever been outside of a crisis, ever, that deficit will grow even more, and it will try to fill in some of the lost consumption from consumers in a recession, in a downturn. Ooh, chat is popping off. Let me pause here. We've gotten through most of the big points. There's still a couple other things I could touch on, but we've gotten through most of the big points. So I'm going to pause, rehydrate myself, and see what's been going on in this chat. Oh my gosh. Let's see here. Brandon Hammond gifted a membership early in the stream. Thank you, brother. Thank you so much. Brandon gifts a bunch of memberships on here. Gorgonite 512 gifting 20 Alpha Beta Soup memberships. Holy shit. Thank you, bro. Bro or sis, whoever you are, thank you. That's amazing. Very generous. There are 20 of you now who can join the member stream right after this if you'd like to. Gorgonite also donated. Super chat. Your research has been invaluable to the citizens of planet Gorgon. Thank you, man. Thank you so much. That means a lot to me. That feels good. Andy Philpott came in right after, not to be outdone, gifting another 10 memberships. Incredible. Wow. So many gifted memberships today, guys. And then Brandon Hammond right after him with another 5 gifts. So that is 20, 30, that is 36 new members today. Some of you have never been a member here before, and you can totally hang out for the live stream after this, or the member stream after this. We'll do it about maybe 20, 30 minutes after we wrap this up. And once I get an idea of when we'll close the stream, I'll actually book it so you can see it on your YouTube. Hey, what's up, Matt? I see Matt in the chat, my buddy Myth Coons on Twitter. Give this guy a follow. Let me show you. Let me show you my old buddy Matt. My buddy Matt, Myth Coons. He's an OG Bitcoiner, and he's also someone who does a lot of great research on the mining stocks. If you're someone who likes to do the BTC mining plays, give my buddy a follow. My buddy Matt, follow. I see him in the chat there. I don't see him in here very often, so I just wanted to give him a shout out. XP, member for 2 months. TXMC, thanks for your most delicious insight soup. Dude, thanks. 2nd month straight of the Founders Club for XP Market. Woo! Hey, big spender. That's cool. You guys are overwhelming me with your generosity. Thank you so much. Let me go back and see if there were any questions in the chat. As a friendly reminder, if you want to get my attention, I don't always see the chat when I'm doing my monologue, but I will go back and look through it. And if you say Alpha Beta Soup, it highlights the name. If you say TXMC, it doesn't. But Alpha Beta Soup's the name of the channel. So if you type those words in your message, it pops up bright red and I can see it really easily. Just a heads up. But you don't have to do that. How does a downturning market affect bonds? Michael Walters asks. Well, usually it causes bonds to rise for 2 reasons. The one reason is that interest rates are usually being cut at that point, and so the cutting of rates raises the price of bonds. And secondly, in a downturn, people usually seek safety, and fixed income's one of those places. Bond market's one of those places. Government bonds. So people usually, some amount of the market seeks a bid for bonds in a downturn. 2 years, 10 years, 5 years, whatever. And so the combination of the cutting of the rates and the seeking of safety can cause bond prices to rise quite a bit in that period of time. That's usually what happens. But then once you get back into an expansion and the Fed starts slowly raising rates, usually bonds slowly go down in value over time, though, in the zero interest rate era, we didn't always see that dynamic. Brandon says, can I look at BTC dominance? I think it has topped. I think it looks a lot like BTC's first top in March, April of 2021. So I'll pull it up, but I'll be honest with you guys. I almost never look at BTC dominance like as a chart by itself. The times that I look at it are in the context of the thing I already closed, which was the showing the rotations. When I showed you guys this chart earlier where we looked at the money rotating in and out, I'll look at dominance here, but I rarely ever do any TA on Bitcoin dominance, so I might not be able to provide you with like a really juicy like take on where it is right here, because I didn't really expect it to bounce back up here. You know, I kind of thought 50, 51% somewhere in this area, you know, getting above this structure might be kind of where it stopped, just because I assumed the rest of crypto would continue to grow. But I've been impressed by this here. Obviously, the ETF probably played a role in keeping this resilient and helping to drive a Bitcoin specific bid. But again, I don't know exactly. I'm not going to spend a lot of time on this because I don't have a strong opinion about BTC dominance. I have a much stronger opinion about price charts themselves than I do about this one. Does anyone else get kicked out when a commercial plays? Yeah, I guess that happens sometimes, JB. When I watch other streams, sometimes it does that, and other times it does. I don't know what causes that. I'll look into the settings after this and see if there's some way I can optimize that a little better for you guys. Predicting stuff is impossible. I guess we just don't fight the trend. Yeah, Brandon, that's the case. And I spent some time at the beginning of the stream explaining how we can get things wrong, because I think there is a non-0% of my audience that has the impression that our economic analysis is driving investment decisions, trade decisions, and that could not be further from the truth. What macro does for me is it's personal interest, it's cycle awareness, it's spreading education to others, and in terms of tactically, all that I really get from studying like this stuff is it makes me feel it affects how much cash I'm in relative to my total net worth, and it affects how aggressive I am in protecting my portfolio from downside, which is holding puts. And so I don't really mess with my long-term investing a whole lot. I try to keep it simple. I'm not a macro investor who's constantly reweighting their portfolio based on what I think bonds are going to do and metals and stuff. Like I don't do that. I don't do any of that. If I take a trade, the trade is based on the chart only, the merits of the chart only. And usually the time frame is so short that macro doesn't matter at all. You know, you take a trade, it's over in a few hours or a couple of days most of the time. And macro doesn't matter in any bit for that unless you get a surprise news event. If I got a surprise news event, depending on what it was and how scary it was, that might cause me to pull some bids if I am trading. That might cause me to close out some long positions if I think that they're at risk. You know, I could adjust in that way. But I will never just go around clicking green and red buttons because economic data is rolling in. That's not how I trade things. And so this whole period of time where we've been looking at the economy and the risk of recession and whether or not BTC would run out of steam at around the same time that the economy entered a recession and blah, 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 blah. Like all those linkages, we're still waiting for the market to confirm that shit. Right? Like you can have an idea about what you think is going to happen, but there is no guarantee that any of that will play out remotely accurately. And if you're the kind of person who wants to take a flyer on an idea like that, go for it. That's not how I operate. And a lot of people don't operate that way. If you do, more power to you. But I just don't feel like I have an edge in doing that. I've lost plenty of money in my time in the markets by throwing dollars at something just because it was some like whimsical idea about something in the future, just to watch it flitter away into nothing. And I'm at a point now, I have a family, I've got a kid, you know, I manage our retirement and our finances and stuff. I'm not going to be doing dumb shit with my money. I'm not a degenerate. Like, I'm not going to go put all my net worth shorting Bitcoin because I think a recession is coming. People legitimately ask me that kind of stuff, and none of that is true. That's not a responsible way to behave, in my opinion, for me. It doesn't work for me. So we study the economy. We're going to get some stuff wrong. Our thesis about a recession is not invalidated. That's important to say. We were wrong about Bitcoin. We were wrong about Bitcoin going back to the all-time high because what was partially influencing my belief was looking at the economics and saying the timing just doesn't line up. And if BTC had continued to behave in a temporal way as it has in the past, we wouldn't even be up here yet. You know, you have to use some like special measurement of time to get to a place where a cycle would even be near an all-time high at this point. Most of the time it's still down here at the 618 or below. And so this happened really quickly and threw off my whole expectation about what BTC could be capable of. But I don't think that it changes the entire outlook for the whole cycle for Bitcoin. I don't think that this, just because it did this in the face of data that is less supportive, I don't necessarily then go to the conclusion that that means that this cycle will be just like all other cycles. I'm not there yet. It's hard for me to get to that place mentally because I see so many risk factors. But I'm happy to be long Bitcoin, right? I got a cold storage bag. I would never sell it just on a whim, just because I felt like something was happening. I would need overwhelming confirmation to just abandon all of my positions that are earning me money. I may trim things. I may trim exposure to some alts or take a little profit on something that's up real big, or maybe put a little bit more into cash than I had a couple months ago or something like that. But I'm not blindly shorting this market, and I hope nobody else is, because you just get rinsed over and over again. There was a dude in my replies the other day who was like, man, I think the recession's coming and I keep shorting Bitcoin and I've lost multiple times in a row. I'm like, dude, it sounds like you're just blindly shorting and you're getting the exact result that we would think you would get. You have to have there has to be a clear invalidation for your idea, and hopefully you get a confirmation on your idea and you're not just, buying in at a high risk situation on something that hasn't played out yet. I'll continue to look at the economy the way that I do. I find it very valuable. I don't think anyone else is looking at the business cycle this way. But the timing it's taken longer than I thought, though we are still in the window in which shit can happen. This is not the one. Where is it? This one. We're still in the window in which shit can happen, but it's not guaranteed, and it doesn't have to happen on anyone's preferred timeline. So could this go on for a whole other year? If it wants to, it will, and we'll be here to watch it. I think that is unlikely, but I've been wrong already in this cycle. So be prepared for me to be wrong again. It's just the way it is. Is Apple in the Dow Jones? I didn't think it was. Dow Jones by weight. I didn't think it was. No, it isn't. Microsoft. And now Amazon. Oh shit. I stand corrected. Let me add it back on. You were right. You were right, Ursik. Sweet. Now it's back on there. Let's give it a cool color. No, there's a lot of that. A lot of blue on here. A lot of red on here. Okay, there we go. So Apple was the 13th stock. Apple was the 13th stock that was below zero for 2024. That was red for 2024. So 43% of the Dow Jones is red for 2024, but it just set an all-time high 2 weeks ago. All right. Scrolling through the chat. What if the Dow Jones has topped and the S&P and the NASDAQ just continue going? Well, that could happen, Brandon, but you have to consider the members of the Dow Jones, right? Microsoft is in here, as we've just confirmed. Apple is in here, right? Salesforce, Goldman. Like, there's some big companies, Amazon. If things are just going to keep ripping, you would think they'd all kind of go together. They may move at different times, but they should all kind of go together. One thing that is kind of concerning, I showed you guys this a while back. Oops, not that. That's the wrong layout to do it on. Let's do it over here. DJI, NDQ. Remember this? Remember this chart? Dow Jones over the NASDAQ. This bottom was the tech bubble, March 2000. This bottom was November, December 2021, the high of the recent market before the breakout. And then we're right back there again. See that? Is this the top of the market? Is it? I don't know. Let me get rid of this. I don't know. It was the top of the market here, and it was the top of the market here. Is it the top here? Are we seeing the top of the stock market? Remember, this doesn't have to move up a lot for a big bear market or a little one. The size of the move is not a guarantee of the size of the bear. Why? Because this was the great financial crisis. It's a smaller move than the 2022 bear market, but in percentage terms, it's way worse. And it's because the Dow and the NASDAQ went down together, and the NASDAQ wasn't up nearly as much at that time because it had been recovering from the tech bubble. So are we seeing, and right now, so for this to turn around, that would mean the NASDAQ underperforming the Dow Jones. And what have we been talking about the NASDAQ this entire stream? Weakening breadth since the breakout of the all-time high. Slightly weaker in the tech sector, or stronger in the tech sector, though the dynamic is the same. So it's clearly tech focused. 43% of the Dow is red on the year, despite the Dow being at all-time highs. Nvidia is up 80%. But half the NASDAQ is below its 2-month moving average, 50-day moving average. And so if we're in a tech bubble, if this is the bottom, this is the top of the market, then the NASDAQ is likely to underperform the Dow on the way down because it's driving all the gains on the way up because it has Nvidia and it has Broadcom. And so it is setting up for that. What I don't think we will see, and maybe I'll eat crow on this, what I don't think we'll see, because this is a ratio, is like some just where this just goes on forever. I don't think that's likely. There will be some level of balance that gets maintained in this market. It doesn't mean that it has to turn around right here and go straight down and be doomtown. It could also break through. Right? This is just a ratio, and this just happens to be where the ratio bottomed out before. It could go lower. This isn't a floor, right? It could go lower than this, and then it could turn around. I don't know. It's just really interesting. And the timing of these bottoms are fascinating. Yeah, Bart. Maybe Jerome wasn't prepared for this market pump, so he's talking to himself. It's an odd comment to make. It was an odd comment. That comment he said about that I had it up, where Powell said we should be prepared to be surprised by this economy. Like, what? What are they doing? Catching up with the stream, with the chat here. Thanks everyone. Thanks for hanging out. If you haven't hit the like button, make sure you do that. See a bunch of you asked questions here just recently after I explained the highlighting of names thing. Let's see what those are about. JJ Jacob says, others from 24th December 2020 to the top in May. Copy it and project it to the bottom. Others from, let me see what he's talking about. Let's see, others from 2020, 24th of December to the top. 24th of December. Why the 24th of December? Oh, from here? No. Oh, no, that's not it. It was back here. Well, yeah, I don't know. I don't know why you would be doing it from right there. Maybe I don't know what you're saying. That's okay. Sorry, Jay. I'm not quite clear on that question there. I gave it a shot. Brandon Brandon says, what price do I think BTC will top? Yeah, right. I spent some time earlier saying I'm not going to give you a price target. I was wrong about the price already, so I don't feel that I should be the one to give you a new price target. All right, we're just going to observe and report. If the economy crashes, I mean really crashes, is the government in a position to dole out money again like in the past? So Gary, they may try to. They may try to. The problem, there's a couple of roadblocks to that happening, I would say. The first one being Congress itself is fighting over the deficit a little bit. They're fighting over what the deficit's used on. And there were quite a few Republicans who have, made negative comments about all of the different, measures by Biden to try to stimulate, and they want the government to try to spend less. Maybe they won't. We've seen historically that doesn't matter what party's in the office, the deficits just kind of keep growing, and some of it is carried by its own momentum, right? Like we have entitlements and defense spending that's not going to come down, and those things will make the deficits larger. But for us to rain money down on people again, we would need a significant crisis. And so, yeah, they probably will try to do something like that again. Maybe they try more targeted stimulus, right? Like maybe they give people fuel stipends and grocery stipends, and they encourage people to invest in certain types of securities for retirement, or like they just try to funnel money into different parts of the economy through various policy measures and incentives. That could be what they do instead of the COVID measure, which was the kitchen sink, because they closed the economy down and they felt like they just had to throw money at people sight unseen and just kind of hope for the best. Depending on what the next recession in the future looks like, they may not do that same response. That was a unique circumstance. If they do that again, we are going to have the high likelihood of another ridiculous asset bubble like we had in 2021. Like GME, ARK, collectibles, everything going to the stratosphere. But that was only 4 years ago. The taste is still on the tongues of everyone. And I wonder how much institutional resistance there will be to running that gamut again if we have a real recession. They will stimulate, they'll do things, it's their job. But the level of it, the depth of it, is an open question. Well, I look at some on-chain metrics in the members chat. We totally can. BCB Fanboy says, when moon? Alvaro asks, will we go sideways or down after the halving due to miners selling, or is that something that they don't do? So we usually get some miner distribution when the halving occurs from miners that didn't front run the event. What I don't know what's going to happen this time, Alvaro. And part of the reason I don't is because of hash rate. Hash rate's been going up so much, mean hash rate, that it's hard to know how the miner situation will look in this current halving. On the one hand, I would like to think that lessons were learned from 2021 and that some of these larger operations have made themselves more resilient and more efficient in the last few years in the bear. I hope they were building in the bear, as they say. I don't know. I'm not an expert on the mining market, so I'm not going to try to pretend like I have some secret alpha on this. But the rate of growth of hash, even when price was plummeting and then now rising, like either direction, this has been a really relentless growth of hash rate. And so I wonder how many entities out there are running rigs hoping that they get bailed out by a crazy run because of ETF flows and all this other bullish stuff. I'm wondering if there's a lot of people running rigs who are like right on the edge. Now, recent price action has been helping them a lot. So they're getting bailed out partly, but then the halving cuts their income in half. Ordinals are helping drive the fee market a bit, but that's cooled off just recently. I've seen that cooling off a bit. So, I'm pointing out different factors here rather than giving you an explicit answer because I don't think I have one. And I'm okay with admitting that. Sometimes I have a really strong opinion and sometimes I don't. And here I don't. I don't know what's going to happen. I don't know that we're going to have a ton of miners selling because miners don't hold tons of Bitcoin anyway. But what may happen is a drop in hash rate more than we think. I thought that more strongly before this recent move back up to 60. When we were still down here, if you had asked me that question, I'd probably more definitively feel that we would see a big drop in hash rate. Not just a little one, but a big one. Like maybe 20, 30, 40% of the hash instead of just like a little dip. I don't know. It was almost 50% back here when China banned industrial mining. But when we had the halving in May, it wasn't like that. It wasn't that much of a fall. It wasn't 50%. I think it was 120 to 91. Yeah, it's like, that's 25, 30% maybe. So maybe we get a bigger one than that. I believe sell in May, walk away, says Andy Philpott. Yeah, that could happen too. Seasonality is a thing. There will be more duration, more issuance coming to the market. Not duration. There'll be more bill issuance coming to the market, more debt being issued. I think in Q2, there's a lot of that. So maybe some of that starts to weigh on the rally a little bit. We'll see. Kind of depends on what Powell says in the next FOMC. But shit, based on the way Powell's been acting recently, I feel like the dude's totally checked out. I feel like Powell declared victory in December when he was practically giddy at FOMC. And he's just, coasting us into the landing now. He thinks that it's all over with and that victory has been achieved. This is my opinion. The victory's been achieved and he just seems kind of checked out. He was real fiery early on in the cycle. There were a couple of moments where he came out and he just sounded like he meant fucking business. He was channeling Volcker. But that feels like a really long time ago now. Pepe asks, can you tell us some of your favorite YouTube channels and Twitter users to get more quality information similar to the info you provide? Who are my favorite people? Well, I don't know. I don't actually follow that many other people's stuff these days. Yeah, I'll think about that a little bit. If I come up with a list, I'll tell you guys. But right off the top of my head, I'm blanking a little bit because I don't want to just start like naming off a bunch of Twitter accounts that I follow. I'd rather give you guys a more thoughtful answer. Let me think about that a little bit. What the Filecoin, says Julio. What's happening to Filecoin? Is it ripping? Oh, wow, it's up 20%. So guys, I don't know if you know this, but everybody needs storage. Nobody has enough storage. Full disclosure, I have an alt position in Filecoin that I acquired back here. And that position was acquired for a swing trade. I don't give a shit about Filecoin. I don't even really know that much about them. But I know that they're called Filecoin, and that's funny to me. And you can always make the meme that everyone needs storage, right? So maybe they're just going to do well on that basis alone. But the whole reason I'm long Filecoin is because, me and my buddy, we discovered that there is a grayscale product and that it has a ridiculous discount to NAV. And that's it. That's the whole thesis. So I bought a bunch of Filecoin and it's now done a 3x since that moment. So that's kind of funny to me. That's just funny. And it doesn't mean I'm a good trader. It doesn't mean that was a good idea. The entire altcoin market is up. So you could have literally closed your eyes and thrown $1,000 at the wall and it would be $3,000 right now. But that's no promise that it will do that from here forward. I genuinely don't know. I'm not an expert on the altcoin market. I am a player in the market. I have fun in the market. I watch it, I observe it. But, if you're trying to talk to me about the different categories of coins within it and the narratives and all this kind of stuff, that ain't me. But, I see an uptrend, I buy stuff, and then I sell it later. And that's what I did. So Filecoin is one of my holdings. I also have some Pepe, which has done really well. I actually sold a bunch of Pepe on Tuesday. So when I tweeted this, I'm just telling you guys this because I want you to know I'm being transparent here. I'm a Bitcoiner, but I also trade. And when it comes to making money, I want the percentages. And BTC is a holding of mine. But if I'm going to trade a swing play to make money, other things might run more than BTC. So I want exposure to those things. So I have ETH, I got Filecoin, I have some Pepe, and I'll sell that stuff into profit. And I said the other day, actually, I'll go back and I'll show you. It was March. My cat got sick. So I got confirmation that my cat has cancer. We thought she was sick, but now I've been confirmed that she has lung cancer. She's 15. She's probably not going to live too much longer. And it just tore me up on Tuesday because I've had that cat since before Bitcoin was born. My cat predates the white paper. And she's been with me since my 20s. She's like the last living vessel of my 20s. And both of my parents are gone. Both my parents died recently. And so she's all I got left. And so I got really upset on Tuesday when I found out that my cat was sick. But what I did was, where did I say it? I said, I tweeted it out. Okay. Well, I can't find it. Sorry, guys. I was trying to show you my tweet. Oh, here it is. My kitty has cancer. I didn't want her to go out like this. I will soothe my grief over my cat by taking some profit from meme season and having a margarita with lunch. So when I tweeted that, I sold some Pepe because it was up here. March 4th, this day right here. I sold this wick of Pepe. It's higher now. I still have some of it, but I sold the vast majority of my Pepe because it was from down here. It was from farther back than that. It was from, where did I get it? Where did I have it from? November, December? I don't know. Somewhere in here. Not a huge amount. I'm not I'm not making making 9 figures from this shit or anything. But I traded the Pepe. I sold the Pepe, and that is how I soothed my grief. You have to take profits in the market. All right. People will try to tell you never to sell. If you want to take some profit, do it. Do it, because you know what sucks ass is never doing that and watching everything turn around and go back, and you lose the opportunity to have done that. So I take profit. I am not afraid to do that. I'm not afraid of getting left behind, quote unquote, because there's always another trade. There's always another opportunity. There's no make or break thing that you have to do right now that's going to change your life tomorrow. And if you fuck it up, it's over. That's not true. And people will demonize you for taking profit on Ethereum or BTC or Pepe in meme season or whatever the fuck, because things could go higher. Yeah, they could. It's why you don't sell 100%. You sell a portion and you ride the rest, and you have an invalidation. If you want to sell it all, sell it all. Go buy a house, live happily ever after. Who cares? It's your life. Use these assets to increase your wealth. That is what they're for. If you can do that. If you're afraid to do that, don't do it. Passively invest. Allocate over time. Let it happen slowly. Recognize your weaknesses. I'm not telling you to trade, but I do trade. I like doing it. I get excited to do it. It's fun for me. And I'm not going to stop. And so when things go up a lot, I'm going to sell. I have sold some Bitcoin in this cycle. Not my long-term hodl stack, but I bought BTC in October when I was buying my meme plays. I added a little more BTC, and that was sold. I sold some at 38. I sold some in the middle 40s, and I sold some this week. I think I sold almost nothing this week. Most of it was actually gotten rid of in the high 40s, right as the ETF was being launched. I still have Bitcoin. I'm not at a zero. It's actually, I have more in cold storage than I had in my swing trade, because cold storage is a long-term bag that I slowly added to over years, right? Over like 2-3 years. But take profit, pay yourself. There is no glory in watching an unrealized P&L. None. Because it isn't real until you take it home. It isn't real till you take it home. And like, market caps are a meme. And so people are sitting there watching the BTC market cap go up. Holy shit, it's at $1.3 trillion. Oh my God, just this week alone, it added another 250 billion in market cap. Okay, how about all of us go try to collect that right now? You can't. Guarantee you can't. If 1% of Bitcoin holders all at the same time decided to try to realize some of this, this would fall way more than 1% because of liquidity and volume. And so this number is just an illusion, right? Like, you can see it on the page. It can tell you how much money you have, but you don't have it unless you leave before everybody else does. You have to leave before the other sellers, or they will take your unrealized profit. And if your time horizon is a decade on an asset that you're holding in, I'm using Bitcoin as an example. I'm not talking about you need to all sell your BTC. But this is a channel. We talk about Bitcoin. I'm using it as an example. You could use anything as an example. It could be NVIDIA. We could be talking about the market cap of NVIDIA. There's some of you listening to me right now that are holding some of this shit. It's worth $2 trillion. On a weekly basis, it's adding, $200-300 billion of market cap. Now, I want all of you NVIDIA holders, go out there and try to realize your unrealized P&L. You'll get some slippage. You're not going to get that number. And if there's an event that creates a feeling in a bunch of people that they need to do that in close proximity to each other, then a bunch of people's unrealized P&Ls are going to get destroyed. And they'll have never left with any of the profit that they celebrated over holding. I'm a family man. I got bills to pay. I got a mortgage, right? I got a kid I'm trying to save money for, right? We want to live our life. I'm not going to dump money into crypto as a black box forever and never take profit. That's stupid. Brandon Valentino with the super chat. How do I become a member? I don't see an option. Well, Brandon, if you go to the front page of the channel, you will see a button, youtube.com/alphabetasoup. Right here, join. If you're subscribed, if you're not subscribed, it might say subscribe next to this. It's my channel, so I can't subscribe. But that's how you become a member. Eric Martinson gifting another membership. Thank you, brother. Welcome to the chat. Good to see you. Good to see you. So let's check around on the stocks. Let's get an idea of what things are doing, and then we're going to wrap up this stream. I think what we're going to do is, it's 12:34. I am going to schedule the member stream for 1:15, which is a little more than half an hour from right now. I'm scheduling it right now. It will show up for you in your feeds, and we will do that right after this. If you haven't hit the like button, please do so. If you're not subscribed for some weird reason, subscribe to my channel. I'm TXMC. These are just my opinions. None of this is market advice or financial advice. I don't want you to try to copy trade me. I don't even tell you guys my trades on purpose to avoid that scenario. This is a place to express our thoughts about the market, to do bespoke analysis that no one else is doing anywhere, and to share our thoughts. Why is the daily volume on NVIDIA, an asset with such big of a market cap, So low. Altcoins have hundreds of millions, if not higher. Well, Jay, that is a very good question. Now, the NVIDIA volume, let's see what it is on a daily basis. It's been rising. No, dude, it's in the billions. What you might be seeing is the number of shares. So if you look on TradingView and you type in the volume indicator, like you just slap on the default volume indicator that comes with TradingView, and you look at a stock, it's going to tell you the share volume. So there are 80 million shares of NVIDIA that have been traded today, but each share is about $900. So that is 74 billion in volume. And you can see it's been increasing. Pablo became a member for the channel. Welcome, brother. You will be joining our member stream, hopefully, at 1:15, just after this. If you guys have any last questions for me, go ahead and get them out. We've looked at stocks today. We've looked at the weakness in the NASDAQ, even as it sits at all-time highs. Big red day on the NASDAQ today, though. Holy shit, minus 1.6. Is that all NVIDIA? Is that all because of NVIDIA? It looks like it probably is, if I had to guess, just because it's so big, right? Let's see what the other Mag 7 are doing. Wow, NVIDIA's down 6.4%. Why is that? Was there some news on NVIDIA today? Or are they just down just because they were up so much? Is that what it was? Is it just reflex? Is it just being reflexive here? Or was there some actual news on NVIDIA? Doesn't look like there was any news. Okay, so no news. It is just overextended. It's creating a wick on the weekly chart. Down from the high was 974 on NVIDIA intraday. That is a huge move for a $2.2 trillion stock. Oscar says, I won't be able to catch the member stream. I'll see it later, I guess. You can always catch it later, brother. The replays will be available. So on the Mag 7, I just want to touch on them real quick. And then just because I didn't. So I was watching Apple. Apple's getting down into a danger zone here. Thankfully, we've found some support. And as it often does, it was at the halfway mark of this demand zone. Look at that. Perfect. Perfect. And the reason this is a demand zone is because on the daily chart, this was the down candle that led to the up move that broke the prior pivot. This was a change in market structure. You could also say this was the break of the pivot, this very small one, but really this led to 10 candles in a row that went straight up and broke this high and then led all the way up to here. And so this creates a level of demand, and we've come down and tested it again. And what you want to see if you're a bull and you're using this as a tool, if you're a bull, you want to see the candles respecting about halfway. Maybe there's a wick, maybe there's a couple of wicks, but then you want to see the candles close here. And that's what we've gotten. And now we've bounced back up out of this level. Maybe it's a dead cat bounce on Apple. I don't know. But that's where it needed to turn around, because otherwise the next level down's like another 10%. So glad to see that. How about the Russell and Wyckoff? Yeah. Russell looks like it wants to break out. Of course, it's sold off some today after this move from NVIDIA. It looks like it. It looks like sign of strength, right? At the top of the Wyckoff accumulation. Maybe it pushes higher. I don't know how high it's going to go, though, because many of these businesses are hurting right now. They're hurting because of interest rates, because they cannot afford to roll at the new cost of money, which is something we've talked about on this channel a lot, how there are a lot of entities out there who have not refinanced their debts. They cannot access debt because their credit worthiness has fallen. The value of their assets has fallen, and interest rates are significantly higher than they were 4 years ago when many of these entities last accessed debt. And so that is a real problem. I showed you guys a clip a while back about how Lacey Hunt agreed with me. And then today, I saw a clip. Yeah, so here's this one. Yeah, here it is. Today, I saw a story that Howard Marks now agrees with me. Howard Marks says he still sees companies swimming naked with debt maturities yet to hit. Quote, the tide hasn't gone out yet. The test for credit arrives next year, according to Howard Marks. Maybe I was a little bit early on it. I really don't know. I'm not a trader in the credit markets. But I identified the problem, and I gotta be honest with you guys, it doesn't make me really feel good when legendary investor after legendary investor is agreeing with your boy TX. It doesn't make me feel good. Lacey Hunt agreed with me. He actually told me that I articulated the argument better than he could. And now Howard Marks is saying what I've been arguing for you guys. Do you know which picture it is? Do you know which chart it is? Do I need to bring it back? I will. I'm going to bring it back. I'm going to go find it because it's way the hell down here now. But I'm going to bring it back. And you're going to see it and you're going to go, damn it, he always does this. Here it is. This is the chart. This is the problem with the credit markets. All the debt was born in zero interest rate policy. I say all, most of it. As of a couple of months ago, pricing of interest rate cuts was all the way down to 4 from 5.5. But the Fed has been signaling much less than that, right? At first, they were signaling about this much. Now, after we looked at the various Fed governors that have said maybe 1, maybe 2 cuts, now we're looking at up here? Like, is that actually all we're going to get? But this is actually how many cuts they need to deliver to get us back down into this box where people can access debt at a similar price to before. If they can't, they have to make hard choices, right? They have to cut costs. And for a lot of businesses, that could be employees that they have been holding on to as in a historically tight labor market. XP Market says, do I primarily identify myself as a trader or an investor? I would probably call myself a trader more than an investor. I do invest in things, but I don't do fundamental analysis. You know, I don't study cash flows and Sharpe ratios and, you know, all that kind of, I don't follow earnings that closely on like, you know, to the stocks, to various stocks and things like that. My investing is quite simple. So I would consider myself more of a trader. I like trading. I like picking apart the chart and identifying levels, executing on ideas and watching them play out. I love that stuff. I wish I did it more often, but having this YouTube channel, it kind of splits my time. And I don't want to stop doing the channel, so I'm going to split my time. But if I didn't have this channel, I would just trade all day long and try to get even better at it. But because I've been doing both now for the last couple of years, my progress on trading is kind of slowed. I'm still getting better over time, but the ascent of progress that I had at first has changed. The trajectory has changed. I don't know, Oscar. Oscar asked me, when would this debt refinancing hit the economy in a real way? I don't have a time frame for you because no one really knows, right? We can look at charts of maturity walls. Like, you know, there's a lot of charts flowing around that show you how much debt is expiring in each of the next few years. We can use that stuff, but it doesn't tell you the nature of what is expiring. Right? You don't know the details inside there. It's just a distribution of debt maturities. So it could be this year, it could be next year. It really depends on how long they keep rates elevated. Because right now the market still believes rates will come down quickly enough that refinancing won't hurt. And so this year is about finding out if that's true. All right. We're going to wrap up here. The chat has slowed down a little bit. I got through most of my points. You guys seem to have asked most of your questions. Hit the like button if you haven't. Share this video and my channel with your friends and family if you think that it would be of interest to them, if you think they would find me entertaining. Really appreciate that. We're getting close to 20K subs, guys. We're getting real close. What are we at? 19.9. What's the actual number? Hold on, I'll tell you the actual number. The actual number, we are at 19,948 subscribers. I am only 50 away from 20K, guys. 51. If everyone listening to me right now had half of a friend that they recommended to this channel, I would be at 20K today. So let's do that. Thank you to all of my channel members. We will do a live stream together, a private stream in 30 minutes from now. If you look on your YouTube subscriptions list, you will see it there. You can hop in the chat right now if you want to, just like this one. I'm going to take a break. I'm going to walk downstairs, feed my cat, drink some water. And then we'll come back together. We will reconvene. I will not be doing my big long spiel of all the points I want to make. We'll just kind of riff. We will look at some on-chain stuff as Brandon Hammond requested. I believe it was Brandon Hammond. And then we'll take it from there. It might not be as long. It's Friday. I don't want to keep you forever. I wanted this to be less than 2 hours. It is, but it's not as short as I wanted, which is very typical for me. So we'll keep the member stream. It will be shorter than this for sure. Maybe 30 minutes, 45 minutes, an hour tops. So with all that said, I appreciate you hanging out with me here today. This is a really tricky spot in the market. I'm not going to give you a big, bold call about anything because I feel like I've done enough of that before. And so this is a period of time where I want to open my mind, try to take in information and not immediately apply a bias to it, and let the market show me what it wants to do. All the criteria are in place for a particular kind of negative outcome, but it hasn't manifested, and it doesn't have to. But we have to pay a lot of close attention and not just assume that because it hasn't yet that it won't. There is still time available for that to play out, and that is throughout this year. So we'll just keep following the data closely, the data which supports us being vigilant. So with all that, take care, everybody. Take care of yourselves. Kiss your kids, call your mom, hug your cats or dogs or chinchillas. And I will talk to most of you next week, and hopefully many of you in about 25 minutes from now. Take care and cheers.